Hello, everybody, and welcome to this edition of the T+1 webinar for Asia Pacific. We are delighted to be welcome all of you to this value exchange discussion, where we're going to take you through what the challenges, opportunities, and outlooks are for the transition to T+1. And I'm delighted today to be joined by Charmaine Lee from Swift, Yash Puri from FIS, Antran Kwok from Standard Chartered, and Lexi Maris from DTCC, who will help me explain to you all how we're perceiving the transition, what are the challenges, and the current state of the possible shortening of the settlement cycle. Now, to begin with, I am going to have a little bit of a conversation about what we did as Value Exchange, which was a survey where we went out and talked to market participants from all over the world to ask them what they expected from the T+1 transition in Asia Pacific, what would be the challenges, what would be the opportunities, and what would the world look like after a transition from T+1. So I will actually start by saying these first 5 points. The first thing is to talk about the fact that 74% of respondents that came to our survey told us that they're actively engaged with the T+1 transition in Asia Pacific. This is actually really exciting, which is good to see compared to the situation we were compared to the transition in the US or in Europe. And what that has meant is that people are paying attention on what's happening. What are the regulators saying? What are the exchanges saying in each one of the regions? And what are the expectations that they need to be putting in? The people that are following the transition seem to have a relatively positive impact. They're thinking that there's going to be enhanced market access. They're thinking that there is going to be better efficiency in the markets, potentially lowering of costs. We'll talk about that in a minute with our wonderful panelists. But we also acknowledge there's going to be some short-term risks, especially when it comes to trade fails. And we will probably feel a little bit of short-term pain with respect to costs. Now, the markets that are most concerning are the tier 3 markets, which are over 60% of respondents have told us that they are really concerned about what could happen if these markets transitioned. Although to the date of the recording today, we already had one of these, which is Pakistan transition, with no major issues. So we will discuss about whether that's something that we continue to maintain as a major concern. And we're also going to be thinking about what is actually the concern for these markets as well as the other markets across the region. Another interesting thing that we saw is that we are potentially underestimating the challenge for T+1. We did have about 12% of people telling us that they're fully ready for T+1 in Asia, whereas we don't really know what Asia T+1 actually looks like and which each of the jurisdictions are actually going to say. So it's going to be really interesting to see what is it that they're saying. And in particular, this is the track for a lot of North American-based firms that are telling us about a third of them saying, I'm fully ready. I'm ready to go for T+1. So really, it's a question, can they really be ready for something that hasn't yet been fully defined? The biggest challenge across all markets, though, it is the funding risk, is really how do I get my money in and out of a particular market in time for a T+1 settlement, right? We have a lot of restricted currencies in the region. We also have a lot of restrictions on the management of the cash in country, as well as the facilities that each of the financial institutions servicing the global investors can provide in country. So really that is weighing heavily in the minds of how do I get this sorted? How do I arrange this to happen as we move forward? And finally, the question that everybody's asking, when do we think that Asia is going to move? Now, for most of the respondents, the date is around 2028. Obviously, it changes market by market, and we'll talk a little bit about that. And again, we've started seeing some markets already planting some flags and some markers to saying, well, this is when we plan to move, and we will talk a little bit about that. Now, how far do we have to go? About 54% right now of settlement instructions are sent after T0, right? And we all know that for T1 to actually happen, we need the settlement instructions to come into position on the same trade date. So we have a little bit of a distance to go. We also have a gap to fill between allocations and confirmations. We'll talk a little bit about that. And in particular, we need to accelerate the allocations coming from European and North American participants, because right now, many of them are waiting until T1 and actually even up to T2 to put all of these allocations in place. And in the other place that was sort of surprising is actually the Asian region, which today actually has to move a lot of their settlement instructions, up to 70%. They have to move up to T+1. Whereas for a lot of the North American firms, which is part of perhaps why they feel comfortable. About 76% are already sending their APAC instructions as being on T+0. The transition risk is very, very focused, as I said, into the funding and also the fails discipline. As many of you know, APAC is APAC markets are actually very disciplined. We do not tolerate failures for most of the markets. There are mandatory buy-in regimes. There are financial penalties already imposed. So really that is weighing heavily into the global investors and the global service providers, saying this is something that might be problematic when we look at T+1. And the funding challenge is not only about getting your hands on the cash, but it's also meeting the deadlines. All different markets have very strict deadlines, and that can come relatively early in the day. So that's something that is not only about getting the cash in position on T+1, but also at the right time on T+1. And for them, it's just going to be almost only half a day after the close of market. And obviously, the hardest hit by this time zone change are going to be the Europeans. About 37% of the North Americans solve this problem by simply outsourcing the FX to their service providers, typically their custodians. But for the Europeans, many of them are actually using their own treasuries and moving things around, and that is going to be something that they're going to need to resolve as we move to T+1. Now, what do we need? What are the big enablers for T+1? Well, our survey found that every single respondent of that's outside the region said that the alignment of rules and timings across the region is going to be crucial. Now, it doesn't mean that all the rules and all the standards need to be exactly aligned or identical, but there needs to be some coherence and some alignment on how we move. Then, in order to make it a success, there needs to be automation in standard settlement instructions. There needs to be trade matching. There needs to be real-time visibility from the investor all the way to the final central securities depository, and that needs to be done on T0. And finally, who is going to be leading the change? Well, 80% of APAC respondents have said that the FMIs are the ones going to be leading the T1 initiative, and 94% of the foreign investors and respondents are saying that it's going to be the trade associations they're going to be looking at to try to figure this out. Now, for now, what I'm going to do is going to invite my panelists who are going to be with me talking about this, and I'm going to start to talk about a little bit of a look backward. And I'm going to start asking to Alexei, who is coming from DTCC, what can we learn from the U.S. transition? I mean, the U.S. successfully transitioned to T+1. It went reasonably well. What is it that made it go well?
Hi, Remy. Thank you for the question. And first of all, I'd say you said it went reasonably well. I would say the short answer is the US transition went remarkably well, especially given the scale and the complexity of the US market, right? So why do I say that? Well, first of all, the success really came down to unprecedented industry collaboration. The SEC set out a clear mandate, and the transition was then driven by deep collaboration. Very early on, DTCC, SIFMA, ICI formed the ISC, or the Industry Steering Committee, and then clearing agency, broker-dealers, custodians, and the buy side were also involved in strong market coordination. There were multi-year working groups, a common playbook, and a strong focus on shared outcomes. Secondly, the industry invested heavily in post-trade discipline on automation, especially around same-day affirmation. That was a critical dependency for T+1, and the data shows that it worked, right? So same-day affirmation rates rose from around 73% earlier in 2024 to roughly 95% post-implementation, which is a huge structural improvement. Thirdly, from a risk perspective, you can say that the benefits materialized quickly. Shortening the settlement cycle did what it was meant to do. It reduced counterparty exposure and systemic risk. The funding requirements at DTC fell materially after go live, around $3 billion US, without any corresponding increase in fails, which stayed broadly in line with the historical T+2 levels. So that's a very strong validation of the model. Finally, I would say the transition was pragmatic. T+1 was an achievable step that encouraged operational modernization while still being resilient under stress. So we, the industry, conducted extensive testing, rehearsals, and tabletop exercises, which meant that the market moved to business as usual immediately after transition, right? So when you take a look back at T+1 in the US, it worked because of this combined clear regulatory direction, strong industry collaboration and governance, measurable operational change, and a focus on risk reduction. So that's why still now, 2 years later almost, it's still being looked at the key reference point for other markets considering the same journey.
Thanks, Alexi. I mean, one of the interesting things you're talking about is that it worked out as was expected. And what was expected here was a reduction in risk and the corresponding return to the market of the risk capital that was able to be returned by the CSD and the DTC in particular, because their settlement risk reduced. Now, and if I can turn to you, what is actually the market expecting from the transition to T+1 in APAC?
Well, when we look at the survey result, we have noted that the correspondent have indeed anticipate positive impact on their business in APAC. So we have seen that 90% is expecting a decrease in their capital requirement, while 16% is anticipating a reduction in their long-term operating cost. We should also take note that 24% is foreseeing an increase in their short-term cost, and especially on the first year of T+1, as they will be driving investment to enhance their automation. Now, we also observe that there are different expectations by market participants. So when we look at the investor, their outlook on T+1 is generally positive, as they are expecting an improvement in their fund performance, better market access, as well as the decrease in their long-term cost. But in contrast, from a custodian perspective, they tend to be more cautious because they are having concern around the possibility of an increase in their fair trade. And especially, as you mentioned earlier on, in this APAC region where a lot of local markets have also almost zero tolerance in terms of fail. The custodians are also expecting an increase in terms of their short-term costs, since they will be working to enhance their target operating model to be ready for T+1. And then lastly, in regard with the broker side, they are anticipating immediate capital benefit, but however, because of the difference in post-trade infrastructure across APAC, they are also raising concern that the operational risk may increase, and especially on the possibility of more error in corporate action. So these are the expectations from the market for T+1 in APAC.
Right. Thank you. I mean, and actually, it's really interesting to think about what the risks are, and really the risks are very much operational. And bouncing back to what Alexi said a little bit earlier, some of that was solved through automation. So perhaps if I can ask you, Yash, what role did the automation play in the successful transition in other markets, or is it playing right now in other markets that are transitioning?
Yeah, so look, I think you've got to look at the word automation, because I think it would vary from place to place. I think where we are with a T+1 or any other aspect is mandatory. But the clever part is, where do you focus on automation? You can't automate everything. So I think you've got to be really strategic in terms of what you do automate versus what you don't. And I think in APAC, many of the firms out there are using matching tools, but they're using it not to its full capability. You've still got manual workarounds, they've got human intervention involved. And I think when it comes to T+1 and the settlement lifecycle, from my perspective, and this is what we're seeing from vendors, is actually, if you can automate the handshakes between the dealing desks and agree the trade on the actual day, you've got a golden source of data that can flow from one system to another system. You can start looking and predicting at issues coming through, right? That's where the value add of automation comes. And I think it's getting rid of those operational efficiencies, because you don't have the luxury anymore with the T+1. And I think even more so in Asia, given the several markets need to settle between 10 o'clock in the morning or 1 o'clock in the afternoon, you're actually on a T plus 0.5. So you've got 0% for tolerance. And you said, right, you get penalized and you get fined by the regulators. So I think from an automation point of view, you've got to be smart in terms of where you're using those bottlenecks or areas which are going to slow you down, because you haven't got the luxury to get slowed down now. So yeah.
Yep. I mean, and well, just coming back to that point, Yash. I mean, is this then automation, or the impression of having automation, what you think is driving people to say they're fully prepared? I mean, you've been involved in the transformation across both buy side and sell side. Like, what drives people to say, "Hey, I'm ready"? Like, we have a third of people saying in North America saying, "I'm ready." 12% of respondents saying, "I'm fully prepared for T+1 in APAC." How can they say that confidently?
Yeah, so I think the stat you pulled out was what 12% are saying they're ready, right? So whether that's fully prepared or not, they're saying they're ready. And so I think it's a great question, actually, because it took me back 20 years when I was doing my exams. My mother kept coming to me, are you ready for exams? So I say, yeah, I'm fully prepared. I'm fully prepared. But actually, as I got closer to the exam, the reality of actually what I was ready for wasn't. It was totally different. So 6 months before, I was fully prepared, but actually it wasn't. Today, before the exam, right. So that's where I think where people are. When they're saying they're fully prepared, I don't think they actually understand what timestamp they're talking about. For me, you are fully prepared if you can fundamentally agree that trade on that day. You can instruct that trade, and you can fix those issues that come with that trade all on the same day. If you can't do those three things, you're not ready. You're not prepared. But that fundamentally, that's what it is. Because again, in Asia, you've got to be able to agree that trade with your counterparts across the globe, and then you've got to basically instruct it, and then you've got to make sure any issues, exceptions come through are dealt with on that day. And so, if banks and firms are saying right now they're fully prepared and they can deal with that, then that's fantastic. But I know as a fintech vendor, and I speak to a lot of my clients, that's not the reality out there. Like, in order for that to happen, you've got to have automation. You've got to have AI tools in terms of, predictive analysis to see where the issue is going to come. You've got to have a clean set of golden data. You've got to be able to have your systems from legacy to cloud enabled to have things flow through. There's a lot there to say you're fully prepared. So, yeah, that's my thought process.
Yeah, no, I mean,
Remy, can I add to that as well?
Of course.
So Yash makes some great points, and I think when you look at the survey, is it possible that some of the respondents, because they moved to T1 in the US, then they say, right, we invested, we automated for US T1, therefore we're ready for Asia T1. But we know Asia T1 isn't going to be the same as US T1, right? Is that fair to say, would you say?
Yeah. I mean, I think you're absolutely right. I mean, and to begin with, the fact that the US T1 was essentially one currency that is highly liquid and fully convertible in all markets around the world. Whereas, like in Asia, we have all these different currencies which have very varying degrees of liquidity, some of which are heavily restricted that require advance notice. And frankly, that's what's causing the most significant concern in the market. I mean, it's related to the cash. It'd be interesting, I mean, Charmaine, if you can just give us an overview of the obstacle of the movement of cash in the region, which is crucial and fundamental to be able to settle a trade.
I've got this question because I'm Swift, right? The cash question. I know it's an interesting question because actually the current rate of fails that we have observed from, the data on our network, the current rate of fails due to cash issues, like awaiting money, etc. It's actually kind of low, like less than 2%, because lack of securities is actually the biggest reason for failures, and that's like more than 50% of what we call, if you know the codes, is the PENF, right? Because, and also there's netting obligations, of course, that help to reduce that risk. But of course, in the brave new world of T+1, and Asia is, of course, very, very fragmented, that it paints a different picture. Because you got different markets, you got different currencies, they're all migrating potentially at different times, depending, the tier 1, tier 2s, and tier 3s. So what we kind of foresee, and we also predict, there's a more kind of requirement for more dynamic management of FX and funding. As you mentioned, right, is it going to be done by your own treasury department, or as opposed to relying on the custodians and their liquidity solutions? So this is going to be very, very crucial. So in fact, we're looking from our Swift data that we published last year, that T+1 kind of ebook, we observed that, post the US migration to T+1, that FX deal sizes for T+0 and T+1 executions, the value had actually reduced by 50%. And then we saw the volume go up by, almost the same amount, right? About 50%. So basically lower values, but higher volume. So that kind of reflects on that more dynamic management as well, of that FX, as I mentioned. The other thing, of course, will be something that people need to be aware of is, and I think I was mentioning a couple of times before, the need for more automation of these kinds of FX and funding workflows, even though you might be familiar already, you got your own correspondent banking network, you got your own custodian solutions. But of course, with T+1, especially if it's and it was mentioned before, a tier 3 market, there's a non-CLS currency. So it's, more illiquid, and you need to kind of match with a US dollar, and potentially that kind of complicates things. And then you also have to think about hedging, potential currency devaluations, right, with these currencies. So there's a lot to consider. So what becomes very important is the ability to forecast, the ability to be able to see the transparency of all these intraday liquidity flows, to enable that better forecasting. And when we spoke to a lot of our customers in India, after that kind of T+1 migration, they did say, they had to rely a lot on pre-funding. And also custodian solutions, they were quite happy with that. But of course, there's additional costs involved, of course, with these solutions. But yeah, as it was mentioned before, there's cost savings in that $3 billion. So you kind of win in one end, but you might have to lose in one end, right? So I think that's the kind of trade-off that institutions have to work out. Where to put the investment and the costs, and where they can win, right, in that lower margining. And also it was mentioned, I think it was Yash, right? It's essentially a T plus 0.5, right? Because now we're T 1.5. So that's a very, very tough cutoff to deal with the FX kind of conversions as well, especially if it's a non-CLS currency. Of course, if it's the tier one markets, it's not so bad. But yeah, I think one thing interesting, digital currencies, you hear a lot about whether it could, on-chain settlement can help to enable, atomic settlement or faster settlement. That's something quite interesting as well. That might play out depending on when the migration happens.
Yeah, no, that's absolutely spot on. I think that, all of these things are things to keep an eye out. And as you said, I think right now the pressure on the treasurers is going to be really high, because at the moment what usually happens is, the broker or the custodian just gets the list of all the transactions for the day, nets it down, checks over the figure over to Treasury, which looks at their demand ladders and are able to somehow move the cash around within the T2 FX markets. And as you rightly pointed out, Charmaine, I think that India is the one that had to do some changes. They did a 24 FX market, although maybe I'm wrong, and I'll look to you, Lan. I think that's less being used, but it's more for a lot of the institutionals and a lot for the foreign investors. It is relying a lot on pre-funding rather than same day FX or 24 hours. So Anne, from your perspective, do you think we're going to be really completely focusing and relying on pre-funding for dealing with T1 settlement?
So when you look at the survey, and especially in the T+1 environment, obviously it is a compressed, shorter settlement cycle. So the investors gonna to have shorter timeline in order for them to look and complete all the post-trade activities, and especially on the FX and funding. So we have seen in the survey that one of the top risk agenda of the correspondent is rely on the FX dealing. And indeed, in that context, pre-funding or same-day FX execution may be considered. Now, on the pre-funding, it is a possible solution, but generally many may not be the preferred approach, as I would say, especially for the asset manager. This is because it's going to impact the return of their portfolio. Now, investor, in the other hand, can also consider leveraging on the custodian FX services to execute same-day FX transaction. And that, I think, it will help them to manage their funding more actively and more efficiently. Now, you mentioned about India, and I think that in the India experience, which transited to T+1 back in 2022, and then on the optional basis, T+0 in 2024, I think this is a good example of how the FX market infrastructure can be enhanced to support the shortening of the settlement cycle. So looking at the transition in India, what have they done? First, they have done a faster FX execution where the regulator have highlighted that their FX market is now operating 24/5, as you mentioned. The bank are also expecting to provide FX pricing whenever their client is requesting. We also see an improvement in terms of the liquidity access, where on the T+1 allowed the foreign investor to receive and repatriate their fund more quickly. The central bank are also ensuring the liquidity support so that the local bank can have sufficient funding in terms of supporting the T+1. And also please remember also on the availability of RTGS throughout the day. And that's also allowed the market participant to manage their funding flow efficiency. So last market enhancement that we have seen is also on the greater operating flexibilities, where the RBI also permits the FX to be booked on trade date until early morning of T+1, and that's also give the flexibility in managing the funding timeline for the investor. So those are the change that I could have seen in the market, in India market, that support their shortening of the settlement cycle.
Yeah, I mean, and thanks, and because I think that there's also some other changes in that space happening. We see already, for example, Korea, not for T+1, more for the extended trading hours, but they also are able to change the RTGS because, as you point out, it's a crucial element to have the RTGS system operating on times. And frankly, that's also what drives a lot of the cutoffs that Yash and Charmaine already talked about. The fact that you end up having T plus 0.5, and when you're actually doing T+1. The other big challenge for APAC is that, as I said at the beginning, I mean, APAC is notoriously harsh on the settlement fails. So you have some markets that will make a mandatory buy-in right away. Some of the markets that will give you severe penalties, almost like 2 strikes and you're out for some very, very strict markets. So, I mean, I'm trying to think about, and Alexi, maybe this is a question for you. How does this complicate the implementation of a shorter settlement cycle in our region?
Yeah, thank you, Remy. I would say you're absolutely right. Okay, so the APAC settlement discipline, I would say it's both a strength and it's a complication when it comes to moving to a shorter settlement cycle. So what do I mean by that? Well, we know many APAC markets operate with very strict, both financial and reputational penalties for settlement fails, often more punitive than in North America or in Europe. So that discipline, that actually has helped keep fail rates historically low. But it also, the flip side, it means there's very little tolerance for operational error, right? So when you compress the settlement window from T+2 to T+1, or shorter in practice because of global investors, as Yash mentioned, any break in the chain, be it late allocations, mismatched instructions, FX delays, or securities lending constraints, are going to have immediate consequences for participants. And it's particularly challenging in APAC as well because of a few structural factors. We have significant cross-border trading. There's time zone misalignment with North America and Europe, and that often leaves less time to resolve issues on trade date. And you can also factor in, as Antran was talking about, FX funding windows, local currency controls, which in some markets are already tight and could become even tighter under accelerated settlement. So the stringent fails regime, I wouldn't say it does not make a shorter settlement impossible. What it does do is it raises the bar, right? So it means that T+1 in Asia, it can't be approached as just a simple calendar change. It's going to require much higher levels of automation, earlier trade affirmation, standardized settlement instructions, and strong industry coordination to prevent fails rather than managing them after the fact. And I think that's why in APAC today, we're seeing a much more measured, phased approach by the markets. Markets want to be confident that operational readiness, funding models, and regulatory frameworks are aligned before we look to shorten the settlement cycles. So in summary to your question, the firm's stance on settlement fails in Asia, it's probably a key reason why we're seeing the region be so thoughtful about this.
Thanks, Alexi. As you were talking, I was thinking about the fact that one of the ways that we have in Asia to settle on time, because Charmaine did talk about the fact that most of the fails are due to the securities not being in position. The way we solve it is using securities lending, which is pretty sophisticated, especially in some of the markets. Japan, Hong Kong, Australia, for example, have a very sophisticated securities lending. Now, if we shorten the settlement cycle, is it likely to be an impact on securities lending? Yash, do you have any thoughts on that?
So yeah, I think there's impacts everywhere, right? But if you look at securities lending in particular, I think the short answer is your lending becomes much more time critical. And therefore, let's look at two components. I think your recalls are going to be really important. And then also kind of the truth, what's available. And I guess if you're relying on people, portals, chasing emails, your time is going to slip. And that can basically result into settlement failures. So I think from my point of view, that there are two key points. You need to kind of automate your recalls end to end. And I think that the biggest problem in securities lending is what I can see, we're a legacy system and we're trying to move away from that legacy into more modernization. So I think for me, the reason why we're stuck in this place with manual workarounds and people is because we are used to T+2 or T+3 timescales, right? So going to T+1, I think it's going to be a big challenge in this securities lending. And I think those automation of the recalls, really building event-driven recall flows. So the moment that trade is locked in, the system should trigger the right actions without waiting for any human handoffs. And I think that's one of the biggest points that causes concern. And then I think you've got to understand what you truly are lending. So before you then lend it. And again, do your pre-trade availability checks between the owners and the borrowers and inventory. And I guess if you haven't got that, you're going to struggle settling your trade at T+1 or T+0.5. So I think they're quite nuanced for the securities part. I think just to lay to that as well, because I think to my earlier point, Remy, I think it's a bigger problem out there. Let's not forget the geopolitical issues which are taking place. And I think with T+1, it's kind of mandated. I think we've got to get onto it. We've seen as a vendor our record number of volumes, flows. It's been astounding in terms of how we're having to deal with the volumes and just the volatility in capital markets. And I guess we're talking about T+1 here, but fundamentally it's where we need to head by default. I think where we're going in the market and where the economy is and where the world is, I don't think we have the luxury now to do things slowly and hopefully, we'll get there with a few emails and chases. I think we need to fundamentally change the game plan now. And it needs to happen now, right? So those who say they're fully prepared, really question yourself, are you fully prepared? Just like I was when I was doing my exams.
So that's a really good point, Yash, because I think what you're talking about is that you need to get machines to machines talking in order to automate everything. But I think that we have a hurdle that we need to cross, which is how do we get these two machines to speak the same language? 66% of respondents actually cited common messaging standard as a critical success factor. I mean, and if we talk about messaging standards, I mean, Charmaine, you probably have the ultimate experience at Swift. How could that common messaging standards help to actually get these automations and machine-to-machine talking and the transition in the end?
Yeah, no, very, very happy to hear that figure, right? We're hoping that was higher, but yeah, 66 is good, more than half would say that. Well, with common messaging standards, Asia is extremely fragmented, right? Got different time zones, you got different currencies, different capital controls, regulations, markets, etc. So in a way, the common messaging standards will help to level the playing field. You've got the structured data elements, our favorite market practices, whether it's global or local, which really help to structure the flows, right? And of course, the predictability of settlement. And of course, we have also, transaction IDs that we have introduced, like the unique transaction identifier or the UETR that's used in the payment side. So that helps to increase the transparency in the shorter settlement environment of not only your payments, but also your securities, which I mentioned, which is very key, right, in terms of that forecasting or that predictive capability that Yash mentions. To identify exceptions ahead of time, so you have the proper time on the trade date to rectify these issues. So all these help to improve efficiency, and I mentioned that predictability, very important. The second very important point, of course, is the reuse story and reuse factor for a lot of the offshore, large institutions like Standard Chartered, and even DTCC, as an example, they use ISO 20022, right, for example, for corporate actions and, potentially for settlement in the future as well. So they're already familiar with these MT and ISO standards. So that really helps to reduce the cost of having to do a big kind of migration project in APAC, because they're already using it, right, for other markets like T2S and, of course, cross-border. So that level of confidence really helps when we're dealing with Asia. That's, could be, some say is a wild west, of course, especially, outside of the tier one markets. We like it in Asia. It's very diverse and very different, but of course you have challenges as well. So that reuse of existing standards really helps to, as I mentioned, reduce the investment and costs for especially the larger kind of players when you're dealing with any kind of investment project, right? And then I think you mentioned it as well. I think the adoption level for messaging standards varies a lot. So you got the tier one markets like, Hong Kong, Singapore, Australia, Japan, etc., already adopting a certain level of ISO standards either now or will be, in the near future. It's the tier 2, 3 markets that we, of course, working very closely with to try to get them on that same level of standardization and market practice. So that kind of enables that proper automation that we're speaking about, reducing the operational risk, for especially, offshore institutions, and reduces that kind of potential reconciliation and exceptions processes, right?
Yeah, thanks. It's a very good point. You were talking about how DTC has adopted. I think the interesting thing about ISO 20022 is not only that it's a common messaging standard, but also what has enabled the change. And Alexi, to your experience again on what has happened in the US, the convergence of the communication mechanism is one thing, but it's also the convergence of the processes, especially when it comes to allocations, confirmations, and how you issue settlement instructions, how that is communicated up and down the investment chain. How is that important for the transition?
Exactly, Remy. And it's very important. And in the survey that Value Exchange did, your findings revealed that 84% of the respondents, they identified automation of SSIs, standing settlement instructions, and their maintenance as a critical enabler for successful T+1 implementation in APAC. Right? So it was one of the most critical factors identified amongst participants. What we've seen is one of the most important shifts in post-trade today is the convergence of these processes that potentially were historically in some cases treated as separate. Allocations, confirmations, affirmations, and the issuance of settlement instructions. These might have occurred in separate systems, different systems owned by different teams running on sequential timelines. That model is very workable in a T+2 world, but it becomes increasingly fragile as markets look to compress settlement cycles. And what we saw is a tremendous amount of clients undertaking reviews of their operational models and working with our consultancy teams on what this should look like in a T+1 environment. And the experience from accelerated settlement has been very clear. You can't shorten settlement timelines unless you collapse the latency between these processes that you're talking about. Allocations and confirmations, they need to occur as close to execution as possible. Settlement instructions need to be automated, they need to be enriched, and they need to be ready once the trade economics are agreed. So that's why these concepts of central matching, same-day affirmation, and standing instruction enrichment have become, I'd say, almost non-negotiable best practices in T+1 markets. You can see the accelerated settlement task force in the UK and the working groups in Europe publish those recommendations as well. Right? I'll not talk in detail to Europe, but I do say I'm based in Hong Kong. And what I'm interested in is when the US market moved, we saw a lot of firms in Asia initially talk about automation, look at investment in automation and their plans. And some firms, you could say maybe some smaller hedge funds, for example, in Hong Kong, because of the time difference, they say, oh, we managed to have a few people go in the office a bit earlier because of the cutoff time, right? 8 p.m., 9 p.m., 7 a.m. in Hong Kong. When do the European markets close? When does UK close? Midnight, 1 a.m. So you're not going to be able to throw bodies at the problem potentially if you don't have operations in those markets. So I'm just interested, and we're interested, how does that automation change in Asia as we approach UK and Europe T1 in October 2027? Okay. So I'd say there's clear recommendations about the use of or the handling of allocations, confirmations, SSIs, and it's been published in numerous industry playbooks. So Remy, it is critical to T+1.
Thank you, Alexi. We had a question coming from the audience asking us whether regulators have already announced plans for transition to T+1 and APAC. And frankly, as far as we know, we had Pakistan, which already transitioned earlier this year, and successfully, as I mentioned. We have Hong Kong that has put the plan to move to T+1 in their budget. But it's been done by the government, not necessarily the regulator. And for all of the other markets, it's been up to the infrastructure to signal the market. We have some markers, as I said before, Australia having said that they will move after they transition to their new clearing and settlement system, the Chase replacement that is looking to happen around 2030. New Zealand saying that it will align to that. And we have Hong Kong Exchange saying that they are looking to have operational readiness in the course of this year. That doesn't mean that they have set a date for transition. But all of this means that the intent seems to be that the transition will occur in some of these markets. But the surprising piece is that we haven't really have any indication from the regulators that they themselves are wanting to direct the market, unlike what Alexi was talking about in the US, where the regulator did the big push to move the market towards T+1. We're not really seeing that in Asia Pacific. Even then, I think one of the things that we have noticed, though, is that the buy sides are pretty much looking at the custodians and they're trying to say, you know what, I am not going to worry too much about this, and I'm just going to look for my custodian to make the pain go away. And maybe this question's for you. How much can a custodian really help, and how much do the buy sides really need to look at the transition to T+1 and APAC?
Well, the custodian obviously play a key role in helping a client to adapt to T+1 because they are sitting at the core of the post-trade processing. Now, how does the custodian help the client to prepare for T+1? We talk about FX, funding, and liquidity support early on. And in this context, again, we invite the custodian to engage their custodian to understand the available FX and funding solution for T+1. We also talk about a lot about automation, straight-through processing, settlement efficiency, and monitoring. And that will where the custodian is going to help the client to reduce in terms of trade mismatching, settlement failure, and allow the client to then identify and resolve their settlement issue earlier. But importantly as well, and that's what we have seen in recent case in India, market guidance, industry coordination, where the custodian as their role in terms of market advocacy, they are engaging the local regulator and also the market infrastructure in order to provide feedback and also promote best practice. As I mentioned earlier, in India, for example, when T+1 was proposed, the local custodian working group, as well as some of the regional or global industry forum, was engaging the regulator. And at the end, they succeeded to extend the affirmation deadline from trade date itself to T+1 early morning. Client readiness and education. Custodian is going to communicate to their client the regulatory update and also provide market guidance so that the client can navigate the transition to T+1. One thing that I wanted to say also is that while the custodian are playing a critical role in supporting the transition, the buy-side firm need also to ensure their own readiness in terms of T+1. So to conclude, T+1 should be viewed not only as a regulatory change to comply, but also an opportunity to all of the market participants along the post-trade value chain to get themselves ready, to get their funding in order to resource and invest the future, because more and more markets gonna to move to T+1.
Great. Well, thank you very much, everyone. Before we leave, I would like to ask each one of you to give one thought to all of our listeners on what they should be doing to prepare for Asia T+1. And I'll start with you, Yash, if you don't mind. What is the one thing you would say to the participants to this call on getting ready for those exams?
So I think be ruthless in terms of what you want to continue maintaining in your infrastructure stack, but be strategic where you want to invest. Really think carefully in your end-to-end operating model. Where is it you want to make the investment versus what you want to carry on maintaining?
Thank you. Alexi, what are your thoughts?
Yeah, I'd like to know how Yash did in his exams, but maybe you can tell me later.
Oh, we'll do that. Yeah, separately, offline.
Yeah, I want to
Sounds
talk to Yash's mom. Yeah, what's she thought about?
So in terms of this, I would say look at your target operating model, right? You don't need to wait till the dates come out to be looking at how you're aligned today versus your target operating model. What's the optimal state? Where's automation required? Because these changes, they're very significant and they require, funding, and that could be a couple of investment cycles. So I would say look at what's your target operating model, how you're automating, how you're preparing for shortening settlement cycles.
Thank you. Charmaine, over to you.
Yeah, I would say definitely automate. Of course, use standardized messaging if it's available in the market. And I think it's important to improve your transparency of your post-trade flows, especially not only the security side, but the payment, so you can pick up exceptions ahead of time. And as mentioned, you can rectify it as well, right? As early as possible, potentially on a trade date to meet that T+1 timeline.
And finally, Anne, I think you already gave quite a few tidbits of great advice, but
so again, ultimately, I think to ensure a successful implementation of T+1, all market participants need to get themselves ready, right?
Fantastic. Well, again, thank you very much, Charmaine, Yash, Alexi, Anne, for joining me today. And for all of you participating in this webinar, we hope you have found it useful. If you have any further questions, please do not hesitate to reach back out to us. And know that this webinar will be available in a recording for you to view at your leisure at a later time. In the meantime, it has been a pleasure to have you today, and we look forward to hearing and seeing more of you at the Value Exchange. Thank you very much.